Welcome back to another episode of our City by City Market Pressure Review series. Last time we were looking at Coffs Harbour, a recovering market in New South Wales. This time, let's go further down to Victoria and look at the fast recovering city of Bendigo, understanding its current trends in 10 charts. But before we get into the charts, if you're here, chances are you're serious about property investment. But understanding data itself is not enough. We need to take action. So if you're ready to make the next move, we offer a 15-minute free discovery call. It's just a short chat to understand your goals and see if we are the right fit to help you achieve those goals. To book it in, check the show notes below. So now, let's get started. Chart 1 is an overview of Bendigo's market performance. As of mid-2025, price pressure is still just balanced, 3 out of 5, but it is moving towards a strong fall, and I will expand on that with further charts below. Apart from price pressure, all the other 5 metrics are either strong or very strong. Rental pressure is really high, 5 out of 5. Rental yield, affordability, incoming supply, and cycle position are all scored at 4 out of 5. So overall, fundamentals in Bendigo is quite strong. Chart 2 is the migration trends and population growth rates. The current population growth rate is around 1.1%, not really high. It's actually lower than Australia's average. But the good thing is we are seeing this increasing trend in recent years. It is primarily driven by overseas migration, but internal migration in recent years has been also recovering. We believe this recovery trend is going to continue in the coming years because the local economic conditions are looking really strong. And that leads us to chart 3. Unemployment rate is around 4.3%, well below the 5% full employment mark. And also it is much lower than its last 10-year average. On the other hand, the number of available jobs is much elevated compared to the pre-COVID average level. These two indicators show that the local job market is active, the economy is staying strong, and these will underpin population growth and housing demand growth in the near future. In the sales market, pressure is increasing. The first sign is the declining days on market, which started in late 2024 and sped up in 2025. As a result of the increasing market pressure, growth is speeding up. The speeding up is not really pronounced if we only look at the 12-month rolling trend line, which is the solid green line here. That's why we also want to check the 3-month rolling median trend line. When the market moves slowly, the 3-month rolling trend line and 12-month rolling trend line, they tend to be overlapped with each other. But when the market is speeding up, the 3-month rolling trend line tends to diverge from the 12-month rolling line and go up. And that is what we are seeing in Bendigo now. Another sign of increasing market pressure is the declining inventories. Since early 2025, number of listings has been steadily declining, while sales volumes has been increasing since mid-2025. So inventory in Bendigo has been declining from almost 5 months of stock to the current 3.7 months, which is already in the balanced range of 3 to 4 months of stock. It's worth noting that 3.7 months here is the overall inventory level of the SA3 of Bendigo. On the ground, in many suburbs, inventories have already dropped below 3 or even below 2, so many submarkets have become really competitive. In terms of incoming supply, Bendigo's new house building approval rate has been steady and relatively low. It's not just below 2%, it's also much lower than the pre-COVID average level, so oversupply risks should be low in the short to medium term. Cycle position. Although the last 5-year growth has been really strong in Bendigo, annualized at 8.5% per year, the last 10-year growth was actually quite moderate. 5.5% per year is towards the lower end of our long-term growth rate. That means Bendigo has plenty of room for growth in the medium term, given the increasing market pressure. In the rental market, pressure is also high. Vacancy rate has always been low, lower than 1.5%, but in recent 2 years, it's been steadily dropping. Now it is already under 1%. As a result, rents have been increasing steadily, achieving 6.5% growth in the past year. That's actually higher than last year's sales price growth. As you can tell, yields have improved. In fact, yield has been improving over the past 2 years. Now it is at 4.8%, quite healthy. In the coming year, price is expected to grow faster, very likely exceeding rental growth. So we likely will not see further increase in yield level. But since there's healthy pressure in both the sales market and rental market, and we expect both prices to go up, yield is not likely to drop dramatically either. In terms of affordability, Bendigo has always been on the affordable side. Both sales and rental prices have been undervalued over the past years, except in 2023 and 2024, when sales prices hit record high and interest rates stayed high. In 2025, because wages have increased, interest rates have come down, and prices haven't really increased much over the past 3 years, prices now have come back to undervalued. This is important because affordability is one of the major drivers for housing demand. Being affordable means Bendigo is going to attract more interest from both owner-occupiers and investors. So, what's going to happen in the coming 6 to 12 months? In the sales market, pressure is increasing, as we can see from the declining days on market and dropping inventories. As a result, growth will speed up. In the rental market, pressure remains high with a low vacancy rate. High rental pressure combined with good affordability means further rental growth. Yields, as we have discussed, might not further increase because sales prices are accelerating, but it's more likely to remain at a healthy level, which won't create much pressure on investors' cash flow, especially if we consider the further drops in interest rates. So that was Bendigo in 10 chats. I hope you enjoyed it. If you have any questions or anything to discuss, leave your comments below. I'm Junge, the Senior Research Analyst here at InvestorKit. I'll see you next time.